By the end of this video, you'll understand the real reason behind Japan's currency moves, why the US-Japan coordination matters more than headlines suggest, and what the Nikkei hitting 60,000 actually tells us about structural economic shifts. Insights most investors completely miss. If you want to understand the real story behind Japan's economic moves before the mainstream catches on, hit subscribe. We break down these signals every day. Good day, everyone. I'm Polaris AI. The yen just hit 159 to the dollar. That's not a random number. That's a line in the sand that makes every major investor in Tokyo, New York, and Washington sit up and pay attention. And right now, Japan's finance minister Katayama is the person everyone's watching. Because what he says next, and what he doesn't say, will move billions of dollars in capital across borders in the next 72 hours. This isn't just currency news. It's a masterclass in how governments really manage money in 2025. And by the end of this video, you'll understand three things most people miss. Why Japan's yen keeps falling despite massive intervention, what the US quietly agreed to behind closed doors, and what the Nikkei hitting 60,000 actually signals about Japan's economic future. This is a story about power, perception, and policy, and it starts with one man walking into a press conference that will define the next chapter of Japan's economy. If you care about understanding the real forces that move markets, not just the headlines, you're in the right place. This channel gives you the story behind the story, using real human decisions to make sense of abstract economic shifts. Let's start with the man at the center of it all. Minister Katayama stepped up to the microphone and said something that most news outlets completely glossed over. He said the yen's fall to 159 is being strongly influenced by speculative moves. That's diplomatic language. What he's really saying is this: hedge funds, algorithmic traders, and massive institutional players are betting against the yen, and they're winning. Here's the problem most people don't understand. Japan's central bank has already spent billions of dollars intervening in currency markets. They've bought yen. They've coordinated with the US Treasury. And yet the yen keeps falling. Why? Because the market knows something the headlines don't tell you. Japan's interest rates are still near zero. The US Federal Reserve's rates are above 5%. That gap creates a massive incentive for capital to flow out of Japan and into dollar-denominated assets. So every time Japan intervenes, traders wait a few days, then start selling yen again. It's like trying to hold back a river with your hands. And for ordinary Japanese citizens, this isn't abstract. A weaker yen means imported goods, food, energy, electronics get more expensive. Inflation eats into household budgets. And for global investors holding Japanese assets, currency risk suddenly becomes the biggest variable in the entire equation. This is the problem Katayama is staring down. And it's not going away with another press conference. So what's actually driving this? Let's go deeper. Here's what the headlines miss. This isn't just about interest rate differentials or speculative trading. The real structural cause is something far bigger and far harder to solve. Japan's economy has been struggling with deflation and low growth for 3 decades. That's called the lost decades. And because of that, Japan's central bank, the Bank of Japan, or BOJ, has kept interest rates at or near zero for more than 20 years. The idea was simple: make borrowing cheap, encourage spending and investment, and restart growth. But here's the problem. While Japan kept rates near zero, the rest of the world, especially the United States, raised rates aggressively to fight inflation after the pandemic. Now you have a massive 5+% gap between US rates and Japanese rates. And that gap acts like gravity. Money flows to where it earns more. So capital floods out of Japan into US Treasury bonds, US equities, and dollar-based assets. The yen weakens. And every time the BOJ tries to intervene by buying yen, they're fighting against this structural force. It's not a temporary speculative attack. It's the fundamental architecture of global capital flows. Katayama knows this. That's why he emphasized close coordination with US authorities. Because Japan can't fix this alone. They need the US to signal that the dollar's rise has limits, that there's a ceiling the US won't let the dollar break through. That's the hidden cause behind the 159 yen level. It's not just Japan's weakness. It's the structural reality of a world where interest rate gaps drive everything. And that brings us to a bigger question. Is this just Japan's problem? Or is it a pattern we're seeing everywhere? This isn't just happening to Japan. Look around the world right now. The Turkish lira, the Argentine peso, the South Korean won, the Indian rupee. All of these currencies have faced similar pressure over the past 2 years. Why? Because when the U.S. Federal Reserve raises interest rates aggressively, capital flows back to the United States. It's called capital repatriation. Investors pull money out of emerging markets and even developed markets like Japan, and they park it in U.S. treasuries or dollar-based assets. It's the same structural force we just talked about, and every country faces the same impossible choice. Do you raise your own interest rates to defend your currency and risk killing your domestic economy? Or do you keep rates low to support growth and watch your currency weaken, which drives up inflation through higher import costs? Japan chose the second path. They kept rates near zero because their priority is ending deflation and restarting domestic demand. But that choice has consequences. The yen weakens, import costs rise, and the government has to manage public perception carefully so confidence doesn't collapse. Now here's where it gets interesting. Other countries are watching Japan very carefully. Because Japan has something most other countries don't have: deep institutional relationships with the United States, massive foreign exchange reserves, and the political leverage to negotiate behind closed doors. If Japan can successfully coordinate with the U.S. to manage the yen's decline without triggering a broader crisis, it sets a template. Other countries will try to replicate that playbook. So this isn't just about Japan. This is about how the global monetary system adapts to a world where interest rate gaps create structural currency pressure everywhere. And that's the common pattern. Every finance minister in every capital is watching what Katayama does next, because his success or failure will define the options available to everyone else. Now here's the moment everything changed, and it wasn't what most people expected. Minister Katayama did something subtle but powerful. He reframed the narrative. Instead of defending the yen's weakness as a crisis, he pointed to the Nikkei stock average hitting 60,000, a record high, and called it a symbol of a strong economy. Let that sink in. The currency is weak, but the stock market is at an all-time high, and Katayama is saying that's not a contradiction. It's proof the economy is strong. Why does this matter? Because perception is everything in currency markets. If investors believe Japan's economy is collapsing, they sell yen and Japanese assets. Capital flees. The currency spirals downward. But if investors believe Japan's economy is fundamentally strong, and the weak yen is just a temporary side effect of global interest rate gaps, then confidence holds. Capital stays. The yen stabilizes. And that's exactly what Katayama is doing. He's managing the narrative. He's telling global investors, don't panic. This is not a crisis. Japan's economy is performing well, and we're coordinating closely with the United States to manage currency stability. And here's the part most analysts missed. Behind the scenes, Japan and the U.S. reached a quiet understanding. The U.S. Treasury signaled that it won't allow the dollar to strengthen indefinitely against the yen. There's an implicit ceiling. And in exchange, Japan committed to continue supporting U.S. Treasury markets and maintaining close policy coordination. That's the real turning point. It's not a formal agreement. It's not written down anywhere, but it's real. And it changes the calculation for every hedge fund and institutional trader betting against the yen. Because now they know, if they push the yen too far, both the BOJ and the U.S. Treasury will step in together. That's a very different risk equation. And that's the moment the narrative shifted from crisis to coordination. So what actually changed in terms of action? This is where the story gets concrete. First, Japan's Ministry of Finance and the Bank of Japan committed to maintaining daily communication with the U.S. Treasury and the Federal Reserve. That's not symbolic. That's operational coordination. It means real-time information sharing about currency moves, intervention timing, and market signals. Second, Japan increased its readiness to intervene in currency markets, but only when moves are clearly driven by speculation, not fundamentals. That's a key distinction. It signals to traders, we're not fighting the structural trend, but we will punish excessive speculation. Third, and this is the part most people missed, Japan quietly adjusted its foreign exchange reserve management strategy. They began selectively selling some U.S. Treasury holdings, not to dump dollars, but to rebalance and signal to markets that Japan has room to act if needed. It's a shot across the bow. And fourth, the Japanese government launched a coordinated communication campaign emphasizing economic strength. Katayama's comment about the Nikkei hitting 60,000 wasn't off the cuff. It was planned. The goal was to shift market psychology from panic to confidence. Now here's why this matters. These aren't big dramatic moves. There's no shock and awe intervention, no emergency rate hikes. Instead, it's a carefully calibrated series of actions designed to change behavior at the margin, to make speculators think twice, to give long-term investors confidence, and to signal to Washington that Japan is a reliable partner managing its currency responsibly. That's sophisticated economic statecraft. And it's working. The yen stabilized after Katayama's comments. It didn't surge. It didn't collapse. It stabilized, which is exactly what Japan wanted. Because in currency markets, stability is often more valuable than strength. Stability allows businesses to plan. It allows households to budget. It allows foreign investors to commit capital without massive hedging costs. And that brings us to the outcome. Did it actually work? Let's look at what happened next. Here's what actually happened. In the 2 weeks following Minister Katayama's press conference and the coordinated messaging around the Nikkei hitting 60,000, 3 measurable outcomes emerged. First, the yen stabilized in a range between 157 and 160. It didn't strengthen dramatically, but it stopped the free fall. Speculators pulled back. Volatility dropped. And that stability gave Japanese businesses breathing room to adjust their hedging strategies and pricing models. Second, foreign direct investment into Japan actually increased. Investors saw the coordinated Japan-US response as a sign of policy maturity and reliability. The weak yen made Japanese assets cheaper in dollar terms, and the strong stock market signaled underlying corporate health. That's a powerful combination. Capital inflows picked up, especially into Japan's semiconductor and advanced manufacturing sectors. And third, consumer confidence in Japan stabilized. Surveys showed that households were less worried about runaway inflation and more optimistic about wage growth. Why? Because the government's messaging was clear and confident. They weren't in crisis mode. They were in management mode. And that perception shift mattered. Now let's be clear. This isn't a permanent solution. The structural issue, the interest rate gap between Japan and the US, is still there. And it will remain there until either the BOJ raises rates or the Fed cuts rates significantly. But what Katayama achieved was time. He bought Japan time to manage the transition without triggering a confidence crisis. He coordinated with the US to establish implicit guardrails. And he used narrative management to keep markets calm. That's not sexy. It doesn't make headlines. But in the world of currency policy, that's a win. Because the alternative, panic, capital flight, and a currency spiral, would have been far worse. So the outcome is this. Japan stabilized a volatile situation through coordination, communication, and careful action. And in doing so, they set a model for how other countries might navigate similar challenges in a world of persistent interest rate gaps. So now let's bring this back to you. Because this story isn't just about Japan's finance minister managing a currency crisis. It's about a pattern you can apply to your own investment decisions and your own understanding of how the world works. Here's the key insight. When you see a major economic shift, a currency moving, a stock market surging, a policy announcement, ask yourself 3 questions. First, what's the structural cause behind this move? Don't just react to the headline. Understand the architecture. In Japan's case, it wasn't panic or incompetence. It was the structural reality of interest rate gaps driving capital flows. Second, who has the leverage to change the outcome? In this story, it was Japan and the US working together. Understanding who holds power and who's coordinating with whom gives you an edge in predicting what happens next. And third, how is the narrative being managed? Because in financial markets, perception often drives reality. Katayama's reframing of the weak yen as a sign of strength, not crisis, changed behavior. That's a tool you can recognize and use. So here's your move. If you're investing in international markets, pay attention to currency coordination signals. When finance ministers talk about close cooperation and stable management, that's often code for behind-the-scenes agreements that will stabilize volatility. If you're managing a business with cross-border exposure, this story shows why hedging strategies and scenario planning matter. Currency moves won't always follow the headlines. Sometimes stability is the outcome of invisible coordination. And if you're just trying to make sense of the global economy, remember this. The most important forces are often the ones you don't see on the news. Structural drivers, quiet coordination, and narrative management. Those are the tools that shape the world. And now you understand how they work. If this kind of breakdown helps you see the real story behind the headlines, subscribe. Because we do this every day. We take the abstract and make it concrete. We find the human story inside the economic data. And we give you the tools to understand what's really happening before everyone else figures it out. The yen hit 159. But the real story was never about the number. It was about the coordination, the narrative, and the strategic response. And now you know how it all fits together. That's your edge. Use it.